Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Remember, like,
subscribe, comment, ask questions. We want to get this stuff passed around so more people learn about options.
Okay, stocks had a choppy day yesterday, kind of all over the place on the S&P, but they did finish stronger. After Powell's speech in Washington, once again taken dovishly by the market. So it seems to be a pattern now. Whenever Powell opens his mouth, market wants to hear pushback on financial conditions, wants to hear the hawk come out, and it's not really ever as hawkish as the market's looking for, and then we see a rip. And so we've seen that a couple of times now. Europe and Asia also lagging behind the US markets, which do seem to be in the driving seat right now. Metals also finding their feet. Obviously, they've had a reasonable pullback off those highs last week. Copper bouncing off that $4 level. Gold kind of putting in a bit of a base here. Remains to be seen if it can hold. But a decent bounce in energy continuing to happen. Oil up 3.5% yesterday. Nat gas up 4%. Obviously, we had flagged potentially selling put spreads in nat gas. That seems to be an all right trade in the short term right now. And then API data on the crude inventories showing drawdowns for a change, right? For the first time in like 7 weeks. So kind of helping the oil story there. Volatility-wise, we did see vols softening in US indices. So you see here down anywhere between half a vol and a vol. European vols holding up better and Asian vols drifting slightly. Focus seems to be on very short dated expiry. So, we're talking about 1 week out type stuff. That seems to be the options that people want to buy. And we're seeing that in terms of the term structure. Whereas 1 month and longer options aren't really receiving quite as much love, right? Which is why we see that vol drifting, despite the fact that we are in negative carry, which basically means markets are moving and justifying their implied vols, but no one really wants to buy them right now. Commodity vols also lower. Again, we've seen that for a while. There's a lot of green in terms of carry over the last few weeks. That's kind of all evaporated. We've only really got copper there in green now with still positive carry. But as vols have been coming down and as realized vols have been going up because these moves are now starting to get bigger. We look at oil there with a 1.5 sigma move, uranium with a 1 sigma move. So we're starting to see more movement. We're starting to see lower implied vols. And that is a recipe for carry to go to zero or even negative. And that's what we've seen happen across the commodity space. But copper stubbornly still staying in positive, though it's been there for quite some time. Okay, now if we move on to look at the dollar and what that's been doing. So here we got, it's obviously had a strong bounce, right? We had that 2-day bounce, took it back above to around 104 on the DXY. It is consolidating now after this recent run up. But, it's holding on to most of its gains. Terminal rates in the US are back at around 5.15, which is near the cycle highs. Dollar yen did have quite a decent pullback from 132.5 back to 131. Sigma adjusted move, that's quite large. Treasuries also sliding lower, still not quite at the same pace, but 80 bips lower on TLT, whereas HYG stabilizing and actually having a little bounce alongside equities. Sector-wise, we did see another rally in ARC, but nothing too dramatic. But that's sitting at 43, which looks like quite a healthy bounce from the lows, about 50% odd. So we are starting to think that fading ARC is looking more sensible. We flagged, obviously, put spreads at the end of last week in ARC. We don't think that's a bad trade at all. And at some point, we do see these ARC names kind of fading back again. It's just a question of when, not if, in our opinion. And then XLE having a good 3% bounce alongside the physical commodity, which is a 2 sigma move on the day. And interestingly, vols got whacked on that. So vols are at 27, down 1.5 vols on the day, despite a 2 sigma rally. That I found quite interesting. And if you look at the carry side of things, you've got negative carry in ARC and energy, whereas you've got positive carry in all the other sectors. Okay, what else is going on? So if we now look at the charts that have jumped out. So big resistance at the 4,200 S&P call wall. So obviously our friends at Spot Gamma try and keep track of these things for us to give us some sense where the big levels are. So with the noise over the last couple of weeks, stocks have managed to take higher terminal rate expectations and a stronger dollar and higher yields all in their stride as the short covering of unprofitable tech companies and just companies in general has driven an unwind in this quality versus momentum trade that was going on, right? So last year we had the Dow Jones massively outperforming the NASDAQ. That was people opting for quality names, large cap names, and they were shorting the hell out of all these unprofitable names. And that trade was a pain trade, and that trade needed to be unwound. And we've seen quant books across the street getting obliterated in the last few weeks. Okay, so there's a lot of pain under the surface in markets right now, where quant hedge funds are just getting stopped out left, right, and center. So at first glance, you're looking at the S&P between 4150 and 4200, and it all seems well. And it's not obvious, but if you know what's going on under the hood in the hedge fund community, and particularly in the quant macro, in the quant strategies out there, the long short quant strategies in equity space, then there's a lot of pain on the street. Now, whilst money's been put back to work at the start of the new year, meme mania's taken off again. Option volumes are obviously at records. That's been well flagged, especially in the short dated 0 DTE type complex. Now, apart from just YOLO calls in speculative names like ARK and the stocks within ARK like Tesla, we've also seen a spike in the volume in VIX call options. Okay, and this is somewhat counterintuitive and doesn't really line up, because VIX call options are obviously more a bearish trade. That's a hedge. That's not like a YOLO upside trade that it's a bull market again. That's a hedge trade. So seeing a spike in that is interesting, and it also doesn't really line up with the idea that S&P skew is actually still well offered, right? And it's quite near the lows. It's like in the 4th percentile. So something going on there within the VIX complex that is driving a bid and demand for these calls that doesn't really marry up with what we're seeing on the S&P. What conclusion do I draw from that? There's not a lot I can say about it right now, except for the point that there's convexity being taken out of the market in terms of VIX upside. And that does start to set up some fragility, right? What I was looking for before I started to get worried about a crash in markets was I was looking to see skew go bid. Now, we haven't really seen skew go bid in a material way, but seeing the VIX do what it's doing and seeing that much upside getting bought in the VIX is probably the beginning of that kind of catching a bid. So let's see how that plays out over the coming month. But if we continue to see VIX upside well bid and a big open interest up there, knowing that the street is likely short that stuff, and we start to see S&P skew catching a bid as well, with the market, still trading up, that's going to set up some more fragility to the downside, and that's what I'll be on the lookout for. Now, S&P is knocking on the door of 4,200, a level that's been touted as a good re-entry for shorts from the likes of Michael Hartnett at Bank of America, who has been calling this market like a legend for well over a year. It also coincides with this call wall that our friends at Spot Gamma kind of see currently. Between 42 and 42.15 is where their call wall lies in SPX and SPY. Now, we'd need to see a rolling up of these calls to support a material upside break of these levels. Okay, so I don't think we're going to get that before next week's US CPI on Tuesday. And we, if we were to get a CPI print that triggers a rally, we would then need to see all these calls getting shifted up to believe that that's a sustainable move. But like I say, I think it's highly unlikely before then. And that means in the short term, that's likely going to act as a bit of a cap on the market, right? So for tactical people who want to trade in the short term, leaning against that 4,200 resistance area is probably not a bad way to set up. Okay, next up, the junk has rallied the most. So obviously we flagged that we thought the tech would lead the way on the upside, and that is how it played out. Now, especially the non-profitable tech like ARK. Now I do think a lot of this move has played out, just given the fact that I know that people are getting stopped out and there's a lot of pain on the street. Now, if we take out the tech side of things and just look at where the junk is now outside of that, Russell's probably your best kind of reflection of that. So Russell's up about 6% from sort of the middle of January, whereas the Dow and Europe, for example, are up about 2%. So S&P and Russell are up about 6%. So we're looking about a 4% outperformance in those broad indices, which is a reasonable outperformance over the course of like 3 weeks. Okay. Now we are getting our strategy compass screening as buy puts for a bunch of these equities, obviously with Spot kind of at the top end of the range, with Vol getting hit down. So that's going to be telling you buying puts is your kind of mean reversion opportunity here. Now we like the fact that you can steer away from the large cap tech names by not touching S&P or NASDAQ puts necessarily, and just focus on the Russell, which is the pink one here. So that also is screening as buy puts. So we like the idea of potentially buying puts on Russell as a way to play that we're towards the end of this unwind, and the junk has just rallied too much, and it's going to have to get faded again, basically, right? So if you are of that belief that the squeeze is kind of done and dusted for now, and we think that now the next move is probably a fade of that last short squeeze, We think Russell puts are probably the way to go because it keeps you away from the large cap tech names, which are actually having a bit of a renaissance because not only are they big underweights for a lot of people, you've got all this AI revolution going on, which is kind of the battleground here, and all these tech companies are very well involved in that, right? So maybe they're going to keep kind of re-rating higher to some extent by the market, but we think Russell, given that 40% of the Russell is unprofitable, we think that might be the way to play the short side of this. Okay, so if we then look at the trade, we've said it, right? Outright puts are the way forward. We think another thing we like about the Russell is if we lean on our friends at Spot Gamma, the underlying 194 is kind of where Russell's trading. That puts us well into short gamma territory, which is kind of here. That's more short gamma than we are in NASDAQ, more short gamma than we are in the likes of S&P. If you are to believe these models and there are some underlying assumptions, which I know is obviously for some people is a bit of a stretch, but the point is your starting point is that it does look like the street is less long and probably more short in Russell in terms of volatility than in the other indices. So that's a good starting point if you're looking for a bigger move, particularly to the downside. But from my perspective, as a pure tactical play, I think the setup is there for Russell to have a leg down towards that zone of 188, and that's the way I would play it right now. Okay, that's it for today's one. Hope you found that interesting, useful, and actionable, and I'll catch you all tomorrow. Thanks a lot.